Hello, and welcome to my new YouTube channel called Economic Analysis, where we'll be looking at different aspects of the economy. Today we'll be focusing on debt. So you can see here on the right hand side, they have debt to GDP ratios for different countries. In this journal article by Draker and Reimers, you can see that the threshold level is 85%, beyond which public debt is harmful for growth. And others have found 70%. So these countries having over 100% debt to GDP ratio is not healthy for their economy. Japan, for example, has over 200. United States, 109%. United Kingdom, 85%. It should be noted, however, that in Japan, for example, all of their debt is owned by private individuals. So the Japanese government has sold these bonds on the private market, and private individuals in Japan have bought these government bonds. Whereas in the United States, a lot of it's owned by China, I think 14% if I remember correctly, and also foreign entities like central banks and other foreign entities. Here's a report by the IMF where you can see the debt to GDP ratios in 1932 and 2009. The most interesting aspect of this figure is the difference in the debt to GDP ratios in the United States from 1932 to 2009. You can see there were a low detonation in 1932 and a high detonation in 2009. The reason for this was that they were a manufacturing, producer-based economy in the 30s, and now they are a consumption-based economy. So that's the reason why that change has happened. And here you can see where they've grouped them together, the GDP ratios, and you can see the G20 advanced in the orange here, and the emerging in the blue, and the low income in the red. And the red line is the interesting one, because it's gone up quite a bit, which is pretty interesting. And here we have figure 5, debt to the GDP ratio in sub-Saharan Africa. So we can see that they have a lot of red spots here, so high debt in 1994, whereas in 2009, according to the IMF, the relief programs have helped the situation a bit there. I have a question this. I'll be making a video on Africa and the structural adjustment programs and other relief programs that the IMF has used, and we will look more in depth and see if that's actually true. Here you can see an historical aspects of the US debt to GDP ratios. So you can see that in the 80s, the US had around 30%. You have to remember in 1973, the Bretton Woods system was removed, so the gold standard, and they adopted the fiat currency. With the fiat currency, there's less restriction on money creation. You have nothing to bind your money. So they've managed to be able to inflate the economy quite a lot since then. Also should be noted that Reagan deregulated the financial markets quite a bit. And you have to remember around here in 1999, Bill Clinton repealed the Glass-Steagall Act, adopted in 1933 after the Great Depression. So that's why you see these jumps. Here's an article on Italy's debt problem and why that could become a problem for Europe. So there's a lot of debt on the balance sheets of the banks in Rome and Milan. But this part is important. The main banks in the rest of Europe are holding more than 425 billion euros of sovereign and private Italian debt. That's a lot. So here you can see a map of it, and you can basically see that if the main banks in Italy fall, the effects will be felt throughout Europe. That's for sure. Here they have basically broken it down by banks. You see Deutsche Bank here. I'll be making a video on Deutsche Bank and their problems sometime in the future. Here is basically the bad debt in Italy. The interesting part about this graph is that from the financial crisis in 2007 and 8, it's gone up quite a lot. There's a lot of bad debt in Italy. and it's becoming a big problem, which is why you see articles like those, how it could be a problem for Europe also. Here's household debt, a chart of it, and you can see that it's 100% of GDP in Canada, whereas in the United States it's 77%. You have to remember the GDP in the United States is 20 trillion. That means that it's over 15 trillion, which is a lot. And you see basically the advanced economies have a lot of household debt. But that's because they've all become a consumption-based economies. Here's basically the same numbers, but from the Federal Reserve website, just to confirm these numbers. It's always good to double check your numbers from different sources. Never just believe anything blind. But this basically shows that these numbers are accurate. Here's a pretty interesting graph. It shows household debt as a percentage of GDP. It basically shows that it's gone down since 2008. It's still high, really high, but it has gone down relative to GDP. Remember that. Here you can see the market is still quite high, the debt, and you can see that it's going up again, total debt. This just goes to 2015, 2016, really. So might have changed a bit since then. This one's interesting. You see student loans here from 2004 to 2015. It's gone up a lot. It's one of the big problems in the United States, student loans. Credit cards been fairly stable. Auto loans have gone up quite a bit since the financial crisis. This one's interesting. Household debt relative to GDP. You can see the United Kingdom here is 180%. Here it's basically, like we saw before, around 78% in the US. But in the UK it's a big problem. It really is. And here you can see basically this is the average for the average household, what they owe. So you can see they own a lot in the mortgage. They have credit card loans, they have auto loans, they have student loans. Basically, they have a lot of loans and they owe a lot of money, which is a problem. It's not healthy. But that's because we're in a consumption-based economy, low interest rates, nobody's saving. There's no point in saving because interest rates are so low. It's all about spending. The only investment we really can make is in stocks, gold, silver. You don't have gold, silver, are good investments, but most people and corporations put their money in stocks, it seems. Here you can see a graph about auto loans. So you can see that since the financial crisis, it's gone up quite a bit. So that's pretty interesting. And it's broken the 100 million threshold. So over 100 million Americans have auto loans, which is pretty insane. Here is a graph from the central banks and their balance sheets. It's a pretty important graph right here. So you can see the Federal Reserve had a low balance sheets till 2008. The financial crisis happened, and they started to buying a lot of bonds and other assets, and inflating their balance sheet. This is something what they call QE, quantitative easing. Basically, what it is the government goes out and create artificial demand for bonds by buying it up, and they do it also with stocks. They've bought stocks also, and you can see both the ECB, the Bank of Japan, the balance sheets have all gone up by quite a bit. So that's basically the total assets. This is an interesting figure here. So the S&P 500 index and the balance sheet of the central banks, the lines seem to follow each other. There's a high correlation here between these two. And the S&P 500 is basically the largest companies in the United States in the stock market there. Basically Apple, Pepsi, all these big companies around, I think it's like 80% around the S&P 500 value, in value terms. But you can basically see that the central banks have inflated the stock market. And they can't really change their course now, and because they can't change it now, because they have inflated it so much that if they now start to sell these bonds that they have, they will create a financial crisis. Why? Because there will be an excess supply. So these governments, they borrow money, and then they will have to finance this borrowing by selling bonds. In the last 10 years, the central banks have been buying up excess bonds. If the central banks start not buying the bonds, but also selling the bonds that they have on their balance sheet, it will create excess supply, and it will cause interest rate to rise dramatically. And I mean dramatically. So they can't do it. So they've basically put themselves in the corner. Here you can see from the Federal Reserve webpage, it's basically the same graph where you can see that they've started in 2008 to reduce the balance sheet, something they call quantitative tightening. And it's basically gone down. But what has happened, it's gone down by not that much, but the interest rate has gone up. And the economy has stagnated a little bit. And if they go down much more, they'll create a financial crisis. And then they know that. So they've really put themselves in a bad spot here. Here we have the Greek crisis. So they had to get bailouts in 2010, 2012 from the EU, and 2015 from the IMF. Basically, the problem in Greece was that no one wanted to buy their bonds. So they were spending too much, and there wasn't enough demand on the bond market to buy their deficit spending. But they spent more than they got through taxation. So basically, what happened was that the interest rate went up and up and up until demand could satisfy the supply, which is basically what's going to happen. It's basically the same with the central banks, like I said, with the excess supply. If they start reducing their balance sheets and selling off their balance sheets, their bonds and stocks and other financial assets that they have, and governments still have deficit spending, so they also issue bonds to the bond market, what will happen will be there will be an excess supply, and there won't be enough demand to meet that supply. So to create the demand, they have to put the interest rate up. So the interest rate goes up and up and up until the supply is satisfied. And that's why the interest is going to go up dramatically if central banks start reducing their balance sheets. So that's basically what happened in Greece. They couldn't finance the deficit spending through the bond market anymore, so they had to get bailouts. And it basically serves as a stark reminder of what to look out for in the future. But anyways, that's it for me for this video. I hope you enjoyed the video. If you liked the video, please press the like button and subscribe if you enjoyed the content. My final message would be: never believe what anyone says, question everything, do your research, look at what the facts and figures say. That's the best message I can give. Don't believe anything, don't blind faith, question everything. Anyways, I'm out. I wish you all the best.